You know how sometimes you read like a really complex story
Mm.
and you just wish someone could explain the important bits in a way that just clicks?
Mm.
That's kind of what we're doing today.
Mm.
But instead of a storybook,
Mm.
we're diving deep into the world of banks and finance.
Exactly. Think of it as unlocking the secrets of how money moves, how it makes things happen. We've looked at some, well, pretty recent analysis of the Indian banking sector.
Right.
It's from Goldman Sachs, Nuvama, and also Smith's research to bring you the essential insights.
Okay, so our mission today, our goal, is to take all that info and really extract the core ideas about how banks actually work,
Yeah, how they earn money, how they decide who to lend to.
how they keep our money safe, which is
Ah,
pretty important,
crucial. And the role of technology, all that digital stuff you see.
and how different banks operate because they're not all the same, are they?
Not at all. And maybe a peek at what's coming next.
Exactly. We want to make it clear, interesting, even if you've maybe felt like financial terms are a bit puzzling.
Yeah, cut through the jargon.
So let's kick things off with the basics.
Yeah.
How do banks actually make their money?
Well, the main way, the primary engine, is something called net interest income. People call it NII.
Wow.
And it's actually a pretty simple idea at its heart. Banks take in money as deposits, right? From people, businesses, and they pay a little bit of interest on those deposits.
Okay.
Then they take that same money and they lend it out to others, maybe someone buying a house or a company needing funds to grow,
Right, it's lending.
and they charge a higher rate of interest on those loans. The difference between the interest they earn from lending and the interest they pay out on deposits.
That gap.
That gap is their net interest income. That's mostly how they profit.
Okay, that makes perfect sense.
Uh,
It's like maybe imagine a village money lender. Is that a fair analogy here in India?
Yeah, that works. Go on.
They might borrow some money from, say, a bigger trader at a lower interest rate, maybe 5%.
Hmm.
Then they lend that same money to a local farmer who needs it for seeds, perhaps. But they charge them a higher rate, like 10%.
Right.
That 5% difference, that's what keeps the money lender going, right?
Precisely. It's the same core principle as a bank's NII.
Okay.
And looking at the Goldman Sachs analysis, they actually project that for the banks they cover, this net interest income is expected to be around, say, 3.5% to 3.6% of their total assets in the next few years.
3.5% or so. That feels like a key number.
It is. It's a core indicator of profitability. They show this in their report, Exhibit 9, I believe.
Interesting. Now, they also mentioned something called net interest margins, or NIMs. Is that just another name for the same thing?
It's very closely related, but slightly different. Net interest margin, or NIM, basically expresses that net interest income as a percentage.
Ah.
Specifically as a percentage of the assets the bank has that are actually earning interest. So it gives you a sense of how profitable their lending is relative to their size.
So NII is the total amount. NIM is like the efficiency rate.
That's a good way to put it, yeah. And Goldman Sachs also anticipates that these NIMs, these margins, are likely to hit their lowest point, or bottom out, around the second or third quarter of the financial year ending in 2026.
Q2 or Q3 FY26. Got it.
Again, that detail is in their Exhibit 9. So NII is the raw income. NIM tells you how well they're doing it.
Okay, so that's the main income stream sorted. Now let's talk about who gets to borrow all that money. Banks don't just hand it out to anyone who asks, do they?
Oh, absolutely not. Lending is, well, it has to be a very careful process.
Why is that?
Because banks need to make sure they get their money back. It's fundamental. They have to assess the risk involved with every single potential borrower.
Whether it's just one person or a huge company.
Doesn't matter. They look very closely at the borrower's ability and willingness, frankly, to repay the loan. This whole evaluation, it's really risk management in action.
Right, going back to that farmer analogy. Before lending out those valuable seeds on credit, the lender would need to be pretty sure the borrower is reliable, right?
Exactly.
And likely to have a good harvest, so they can actually pay back the loan plus the interest.
Precisely. And what's interesting is that the focus of this lending in India seems to be shifting a bit right now.
Oh. How so?
Goldman Sachs points out that banks are becoming a bit more cautious about unsecured loans.
Unsecured, so loans with no collateral.
Exactly, like personal loans, credit card debt sometimes. There's no specific asset backing it up. Instead, banks are focusing more on secured loans.
Okay, secured means backed by something tangible.
Right, like a home loan where the house itself is the security, or loans to MSMEs.
MSMEs, micro, small, and medium enterprises.
Correct. And those loans might be secured by the business's equipment or maybe their inventory. You can see this trend highlighted in Goldman's Exhibits 5 and 6.
Okay, so it's less risky for the bank if there's something like a house or machinery they can potentially recover if the borrower defaults.
Makes sense?
But overall, are banks still lending more? Is lending growing?
Yes, there's still growth. Goldman Sachs projects that overall lending, what they call credit growth, will probably grow at an average rate of about 11% each year between the financial years 2024 and 2027.
11% CAGR. That means compounded annual growth rate.
Yes, that's the average yearly growth rate over that period, factoring in the compounding effect.
Okay, 11%. How does that compare to before?
Well, it's actually a bit lower than the growth we saw just before that. Between FY22 and FY24, growth was closer to 15%. That's in their Exhibit 4.
So a bit of a slowdown in the growth rate, but still growing at 11% a year on average.
Correct. Still significant growth.
And do they expect things to speed up again?
They anticipate that loan growth will likely start picking up pace again from the third quarter of FY26.
So Q3 FY26, that would be around October to December 2025 on our normal calendar.
Exactly. And this expected pickup is partly because they think there'll be more liquidity, more money flowing easily in the financial system around then.
Got it. Now, we can't really talk about lending without touching on when things will go wrong.
The difficult part.
When people or companies can't pay back their loans, we call these non-performing assets, right? NPAs.
Yes, NPAs. Or sometimes people just call them bad loans.
Bad loans, okay.
And they are exactly that loans where the borrower has stopped making the required payments, either interest or the principal amount they borrowed.
And managing these NPAs must be a huge focus for banks.
Oh, absolutely critical. Too many bad loans can seriously damage a bank's profitability and even its stability.
And it seems like different banks have quite different stories when it comes to these bad loans. The Novamo report talks about Jana Small Finance Bank, for instance.
Yeah, Jana SFB's strategy is really interesting here. They used to have a higher proportion of unsecured microfinance loans.
Microfinance those smaller loans, often to people without many assets.
Exactly, which tend to carry a bit more risk inherently. But Jana made a very conscious decision, a strategic shift, to focus more on secured lending.
To make their overall loan book safer.
Precisely. And the Novamo report actually mentions, I think it's on page 4, that their secured loan business has grown incredibly fast by an average of about 39% each year since FY22.
Wow, 39% AGR on secured loans. That's a massive shift.
It really is.
So they're moving towards lending against things like houses or gold, which are obviously less risky for the bank. And they have this special program called Home 360.
Yes, Home 360 is quite clever. Novamo explains it, page 6, I think.
Right.
They use home loans as the central product, the anchor.
An anchor.
Yeah, once someone takes out a home loan, Jana then tries to offer them other secured products, maybe a loan for a vehicle or a small business loan secured against property. It's all about cross-selling, but keeping it secured.
I see. So the home loan gets the customer in the door, and then they offer more, building that relationship, but still focusing on security.
Exactly. It helps build deeper customer relationships and increase the value per customer while managing risk.
Smart. Now, on the flip side, the Smith's research report discusses KVB Bank, Karur Vysya Bank. They seem to have a very different starting point.
Indeed. KVB really stands out because a huge proportion of their loans are already secured.
How huge?
According to the Smith's report, page 32, as of the first 9 months of FY25, that's what 9M25 means, a whopping 97.6% of all their loans were secured.
Wow, 97.6%. Almost everything they lend is backed by an asset.
Pretty much. It's a core part of their strategy.
And what does that mean for their bad loans, their NPAs?
Well, as you might expect, because they focus so heavily on secured lending, KVB's slippages, that's the term for new loans turning bad, becoming NPAs, have been quite low, modest, as the report says.
Okay.
And importantly, the Smith's report, again, page 32, points out that these slippages have actually been getting even lower over the past 5 years or so.
So their strategy seems very effective at keeping bad loans under control.
It appears so, yes. Their asset quality is a key strength.
Okay, so we see two banks here. Jana actively shifting towards more secured loans, while KVB is already almost entirely there.
Right. Different journeys, different starting points.
But both seem focused on managing lending risk. Which brings us neatly to the bigger picture of how banks manage risk in general. It sounds absolutely fundamental.
It is the fundamental part, arguably. Banks are, in a way, custodians of the public's money. Protecting that money, maintaining that trust, it's like their primary duty. You could almost call it their dharma in a sense.
Their duty, their purpose.
Exactly. And effective risk management is how they fulfill that. It's not just about credit risk, will the borrower repay?
Right.
It's also about liquidity risk. Do they have enough cash on hand to meet withdrawals and obligations? And market risk, operational risk, many types.
Okay, so how does the overall risk situation look for Indian banks right now, based on these reports?
Well, Goldman Sachs anticipates that credit costs, that's the money banks, set aside anticipating future loan losses. They think those costs are likely to peak, reach their highest point in the first quarter of FY26.
Q1 FY26. And what about profitability?
They expect return on assets, ROA, which measures profitability relative to assets, to probably bottom out around the second quarter of FY26. This is in their Exhibit 1.
So costs peaking, then profitability bottoming out shortly after.
That's the projection. But there's a positive sign, too. They mention on page 10 that the rate at which personal loans, those unsecured ones, are starting to show early signs of trouble seems to be stabilizing, slowing down.
So maybe the worst of the new problems in that area is leveling off.
That seems to be the indication, yes, which is encouraging.
Definitely. So peak bad loans might be near, and maybe profitability starts recovering after mid-FY26.
That's the hope embedded in the analysis.
What are some specific things banks do to manage these risks, especially the bad loans they already have?
JANA SFB gives us some good examples, actually. Page 17 of the Nuvama report outlines their strategies. They've used several tools.
Like what?
Well, they've sold off bad loans to specialized companies called ARCs, asset reconstruction companies.
Yes, ARCs. They try to recover the money.
Exactly, that's their business. JANA has also restructured some loans, meaning they changed the repayment terms to make it easier for struggling borrowers to pay.
Okay, giving them some breathing room.
They've also put more effort into collections, just chasing up payments more effectively. And, crucially, they've improved their internal risk management processes for making new loans to avoid similar problems in the future.
So a mix of dealing with the past and preventing future issues. Makes sense. And they're also learning from recent bumps in the microfinance road.
Absolutely. Nuvama notes, on page 8, I think, that because there's been some stress in the microfinance sector recently, JANA SFB has proactively tightened its rules.
How so?
They've become stricter about how much total debt their microfinance customers can take on, customer leverage. It's a more cautious approach now.
Smart. Better safe than sorry, especially with depositor money. Okay, let's shift gears a bit. Let's talk about something that's changing, well, pretty much everything, including banking technology.
Ah, yes. The invisible force.
How is tech really shaping the world of finance?
Oh, it's completely transforming how banks operate. From, the simple things like checking your balance on an app
Right.
to the really complex ways banks now use data analytics, AI, machine learning to make much better decisions about lending, risk, everything.
Absolutely. Yeah. I mean, just look at UPI here in India.
Perfect example.
It's incredible how quickly and easily people can send money now just using their phones. It shows the power of tech in finance.
Fantastic modern Indian example. Totally agree. And the reports pick up on this too. Nuvama's report on JANA SFB really emphasizes their digital focus.
What do they say?
On page 20, they actually call JANA a new age digitalized bank. They believe this digital ecosystem JANA is building will lead to lower operating costs for the bank.
Efficiency.
And also better ways to engage with and ultimately serve their customers better in the long run.
That makes total sense. Digital can be cheaper, faster, and offer a better customer experience if done well. Now we know, as we touched on, that not all banks are identical.
Far from it.
They have different focus areas, different types of customers. Let's talk about these different business models. It's not just one kind of bank out there.
Not at all. You could maybe think about it like in the ancient Indian text, the Arthashastra.
Oh, interesting angle.
It talks about how a healthy kingdom needs all sorts of different people doing different jobs, different professions, contributing in their own way.
Right. Diverse economy.
Similarly, in the financial world, we need different banking business models to cater to all the diverse needs of the economy. Some banks focus mainly on retail customers, everyday people like us. Others concentrate on businesses, maybe big corporations, maybe smaller ones. And then you have banks that specialize in certain types of lending, like agriculture or infrastructure projects.
So a bank that primarily gives loans to farmers would operate very differently from one dealing mostly with large companies.
Completely different processes, risk assessments, customer relationships, and we see these differences reflected in our reports.
Like so.
Well, take JANA SFB again. Their business model is clearly evolving, right? They started strong in microfinance, but now they're strategically pushing into secured lending, as we discussed.
And doing that cross-selling with Homey 360.
Exactly. That's a deliberate change in their business strategy, diversifying their model.
Okay. And how does that contrast with KVB Bank?
KVB, as the Smiths report highlights on page 32, operates with a model that is, as we saw, overwhelmingly weighted towards secured loans. That focus shapes everything they do.
So a very different, more established path focused purely on secured lending.
Right. Two distinct approaches. And it's worth noting Goldman Sachs in their Exhibit 4 specifically mentioned they expect a lot of the future loan growth to come from lending to MSMEs.
Those micro, small, and medium enterprises again.
Yes. This highlights just how important that specific segment is becoming for many banks' business models and for India's overall economic growth.
Absolutely. Those smaller businesses are such a vital engine. Okay, so we've looked at how banks work today, their models, their risks. Now, let's gaze into the crystal ball a bit. What might the future hold for banking in India? What are the big trends?
Well, predicting the future is always tricky, but several major trends seem likely to shape banking. Technology, for one, will undoubtedly continue its march.
More AI, more digital.
Almost certainly. More AI, machine learning for better decisions, smoother processes, new kinds of personalized services. Regulations will also play a huge role. Changes from the government, the RBI, they always impact how banks operate.
True.
And of course, customer needs and preferences keep evolving. Banks have to keep up, offering convenience, better digital experiences, new products.
Yeah, it feels like banks are constantly launching new apps, new online features.
Yeah.
They have to stay competitive.
They really do. And, thinking about that concept of power laws.
Power laws, the idea that a few players often dominate.
Exactly. We might continue to see a few very large banks leading the way in India, capturing a large share of the market. But that doesn't mean there isn't space for others.
Like niche players?
Precisely. Smaller, more specialized banks, maybe like some of the small finance banks, can definitely thrive by focusing intensely on specific customer segments and understanding their unique needs really well.
So maybe consolidation at the top, but opportunities for focused players too. What's the overall vibe from our sources about where the sector is heading? Goldman Sachs.
Goldman takes I'd say, cautiously neutral stance overall. They see potential near-term headwinds, challenges maybe from interest rate cuts, putting pressure on those NIMs we talked about.
Right.
But they think investors will likely look beyond these short-term issues. Why? Because, as we discussed, they expect the bad loan situation NPLs to start peaking soon, and there might even be some easing of regulations.
So look through the noise.
Kind of. Their main point seems to be about stock selection. Be picky. Focus on banks where earnings cuts are manageable and where you can clearly see a path for future loan growth.
Okay, so careful selection is key. What about Nuvama's view on Jena SFB specifically?
Nuvama is quite positive, actually. They've initiated coverage with a BUY rating. They think it's a good investment.
Why?
They expect Jana's profitability ratios to improve and their asset quality to get better, driven primarily by that strategic shift towards secured lending. That's on page 3 of their report.
So they believe in the transition strategy. And Smith's research on KVB.
Also positive. Smiths recommends KVB as a BUY too. They expect the bank's stock valuation, its rating, to improve.
Based on what?
Based on its strong asset quality, that super high secured loan percentage, and its generally improving financial performance. That's laid out near the end of their report, around page 28.
Okay, so while the overall sector might face some bumps, the analysts seem optimistic about these two specific banks, largely due to their individual strengths and clear strategy.
Yes, that seems to be the takeaway.
All right, as we start to wrap things up now, let's pull out some of the absolute key messages. You've picked 3 quotes that really stood out.
Yes, 3 quotes that sort of encapsulate some core ideas. The first is from Goldman Sachs, page 1. We expect investors to see through the near-term pressures given the following points. 1. New NPL formation should start peaking in 4Q FY 251Q FY 26.
Okay, that's that point about bad loans likely peaking soon. A really important signal.
Exactly. It suggests light at the end of the tunnel on asset quality.
What's the second quote?
The second one is from Nuvama, specifically about Jana SFB. It's short and sweet on page 4. A secure future as it transitions towards secured lending.
Nice. Captures their core thesis about Jana's strategy paying off.
It links the strategy directly to a positive future outlook.
And the final quote you wanted to highlight.
That one's from Smith's research on KVB, page 32. Slippages are modest and reducing over the last 5 years and decreasing across the sectors.
Right, emphasizing KVB's consistent strength in managing new bad loans and that it's improving across the board.
Exactly. highlights their strong risk management track record.
Some really telling quotes there. Now, how about those surprising nuggets, things we might have easily missed? You found two.
Yeah, a couple interesting details. One is from Goldman Sachs again, Exhibit 4. They project that between March 24 and March 27, the biggest chunk of new loan growth in India won't come from unsecured loans.
I know. Where then?
It's expected to come from MSME loans. They estimate MSME lending will account for about 35% of incremental loan growth, while unsecured loans will only be around 9%.
Wow, 35% from MSMEs versus only 9% from unsecured. That's a huge difference. It really underlines the shift in lending focus.
It really does. Shows the growing importance of financing smaller businesses.
What was the other surprising piece?
This one comes from Nuvama's report on JANA SFB, page 7, about their Home 360 initiative.
Ah, yes, the cross-selling program.
They found that, on average, every customer who takes out a housing loan or a microloan against property through this program ends up using about 3.7 other financial products from JANA.
3.7. That's incredibly high. It really shows that anchor product strategy is working wonders for them in terms of deepening relationships.
Absolutely. It demonstrates very effective cross-selling within that secured framework.
Amazing. Okay, finally, as we always like to do, what's one practical action idea for our listeners? Something they can do based on our deep dive today.
Well, building on understanding how banks work, I'd suggest maybe taking a little time to review your own relationship with your bank.
How so?
Do you actually know the types of accounts you have? If you have loans, what are the interest rates? Are you sure?
Good point. Sometimes we just sign up and forget.
Exactly. Maybe just look into the other services your bank offers. Do they actually align with your financial goals? Could you be using something better? A little bit of personal financial housekeeping based on this understanding.
That's excellent practical advice.
Hmm.
Just taking a moment to understand our own banking situation better. Well, banking and finance, they can seem complicated, maybe even a bit intimidating sometimes.
They can.
But as we've hopefully shown today, understanding the core principles, how money is earned, lent, protected, it's fundamental to how our economy functions, and it affects all of us.
Absolutely.
By getting a grasp on these basics, you really do gain a much clearer lens through which to view the world around you. Thanks, everyone, for joining us for this deep dive.